And good morning, traders. Today is March 23rd. It is just a little after 10 o'clock this morning, and the markets are off to a decent but mixed start today. So the Dow's up about 50 points, but the Nasdaq's pretty flat, down 571. So there's not a lot of action in the market today, and we had a good update on Friday. But let's take a look at this S&P 500 chart. This is interesting, right? So here we have this last week's action right in here, and you can see there's a high volume bar on that. Now, that high volume doesn't compare at all to this volume bar here, right, which is the last high that we had in the S&P. So we're going to need a lot of energy for us to be able to break through that, and I don't sense it's going to happen. So I think it's going to bounce up again into this resistance of the upside. So let's take a look at what our normal indicators are. On the New York Stock Exchange, our market timing indicators, let's take a look at it. So what we have is we have a nice uptrend in place right here. See that beautiful uptrend? It's about 10-day long uptrend, and it's continuing. But it's continuing on what I think is a lighter volume environment. And that means that when it gets up here, it's not going to have the energy to break through that environment, and it's going to really pretty much go down on the other side. And what we've been saying here for several weeks, maybe months now, is that we're kind of range bound. If you notice, if you go back in time, you can see there's a range up and down in the market, and it just keeps bouncing back and forth in that. And the reason is there's just not a lot of energy to break through, either on the downside or on the upside. There's lots of news in Russia. There's lots of news in the, with the U.S. Fed printing. There's news in Iran. There's always news, and everybody's worried. And that's generally when the markets kind of creep up. But it doesn't allow for big breakouts, and we're breakout traders, so the environment isn't setting up really well for breakouts. Nonetheless, got to get your buy list ready, and hopefully you've been keeping your powder dry, or at least been short and made a little bit of money on some of the downside calls that we've recommended. And now it's time to get the powder dry on the upside. However, what we see here is there's not a lot of room. See this little dotted line there? That's our envelope bar that shows us the breadth of the amount of room. And we've crept up here in a lousy environment, right? And so we didn't want to be in on that. We can't catch all the environments, right? Can't catch all the trends. It's kind of okay to be on the sidelines. But if you get in here, if you go back and look at some of our past graphs, and you can go back in time and see them, you'll notice that every time it gets to that dotted line, it seems to stall, and we're really close to that. So we're right now in a yellow environment, tending toward a green, trending toward a green, but we need some huge energy to really make it a strong green. I suspect, but I don't know, and we don't know whether the market's going to bounce up here or not. But right now we got to play it cautiously. You can be hedged, which means you can be short and long at the same time. Or you could just be in cash and waiting for a signal to go either way. If your watch list is ready on the upside, get your green watch list ready. Get ready to buy some stocks at proper breakout points. And if it happens to go back to a red market, which it doesn't do very often after it turns through a yellow, then you can get your short list ready. Or you can just stay in cash. This is probably a safe time to be in cash. Nothing wrong with cash. You can't be in the market all the time. And if you're smart, that's how you play it. Good luck.